Investors have worried and watched as the conflict in Ukraine and ongoing supply chain issues have impacted our economy and Wall Street. Joining us this morning, local financial professional Matt Stevenson from Allied Wealth to talk about how we can protect our money as best as we can. Matt, good morning. How you doing?
Good morning, Owen. How are you?
Great, great. Thanks for spending a few minutes with us. Do appreciate it. What are we seeing, kind of your overview assessment of the markets right now?
Yeah, and certainly this is one of the most challenging market environments we have seen in a very long time. Record levels of inflation that we haven't seen in 40 years, interest rates climbing by the day, geopolitical unrest, you name it. It's caused a pretty steep downtrend in not only the stock market, but the bond market as well. For example, when Russia invaded Ukraine, the Dow dropped by more than 800 points at the opening bell. Then on the other hand, you've got commodities like gold and oil that people are flocking towards to hedge against some of the risks that we're seeing right now. And the Fed has caused some unrest too. Every time that they've hiked rates, the market seems to react negatively on the concern that we could be headed for a recession if they continue to raise those rates to combat inflation. Right now, we're seeing a record streak for the market. It's been 7 straight weeks of decline for the S&P, and right now it looks like we may be on the road for number 8 as well.
I mean, how concerned, Matt, should we be about that long, I guess, of a downtrend?
Yeah, and really the thing to keep in mind there, Owen, is that we do see these cycles from time to time, and it kind of leads us into the question of what causes these fluctuations in the market. And really there's 2 main ways that happens. On one hand, you've got the investment risk. So if a company has problems or reports less than stellar earnings in a quarter, that's when the stock can drop. Or on the other hand, if you have good news for a company, the stock can go up. We call that investment risk because that risk is tied to a specific company or investment. Now, there's ways to mitigate this. You can simply avoid buying these high risk, high flying stocks that we've seen on the news from time to time this year. And you can do what we call diversification. You can own multiple stocks or stock funds as opposed to a single company. The other side of this is a lot of what we're seeing right now, which is systematic risk to the market. This is when the entire market's impacted. Events like elections, natural disasters, wars, this can cause these large fluctuations in all stocks. You can't really avoid systematic risk, but you can make sure that your investments in the market are made with money that you don't need right away. And this gives your money time to recover from a decline such as what we're seeing right now.
That brings up the next question, which is what folks who are getting close to retirement, or maybe they're in retirement and relying on that retirement income to survive, what should folks like that be thinking in a time like this?
Yeah, and we work with a lot of clients just like this at Allied Wealth. The big thing here is that we need to have that diversification and make sure that we're taking a risk that's appropriate for your age and whether you are getting close to or in retirement. So investing in that diversified portfolio, making sure that your money is spread across different types of investments. This can help you steer clear of these extreme highs and the lows of the market, and most importantly, help you stay on the right path. You know, money that you know you'll need to spend in the next year or two, we generally put that in lower risk investments. You don't want a market downturn like this to drain your money when you actually need it. This is a big part of what we do with our clients at Allied Wealth. You know, one of the value adds is simply coaching them through these difficult market environments, trying to avoid these emotional decision makings. You know, we all hear the adage, buy low, sell high. That's actually really difficult to do, especially in times like this. So that's where it's so important to keep your long-term goals in mind.
Yeah, I mean, you know, we try to say that, I guess, to sort of be positive, right? It's like, well, it's the Dow dropped however many points yesterday, but it's a buying opportunity. But it's only a buying opportunity if you have money. So
true.
Right. What about some of these other strategies during volatile times like we're in?
Yeah, and we talked a moment ago about buy low, sell high, and that is true. Stock prices are low when the market's pulling back, such as it is, and this may be a good time to put, increased dollars to work. The problem is the emotional factor. Whenever we see the market pulling back, that's when we get anxious or fearful, and we focus on recency bias, or that short-term effect that a correction can have on our account balance. Really, emotions are the driving force behind a lot of investor decisions, and that leads them to sell low or buy high when the market's screaming higher.
I got that fear of missing out or whatever it ends up being. Matt, they're wrapping us up, but I really appreciate you hanging with us and spending some time. I think it was really important with talking specifically about the emotional part of this. I know that's the part folks struggle with, and I know they can get some help from folks like you, Matt Stevenson at Allied Wealth. Really appreciate it, my friend. Thank you.
Thank you.